Brad, how's it going, man? Okay, so I have a question for you. First of all, thank you so much for all you do for all of us. I've watched all your videos and they're the bomb.
You have not watched all my videos. There's too much time. I'm calling fact check on that. You have not.
So, my question to you is if I have a cash secured put and it's rolling along and it's going up, 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 do I sell it, say 50, 60%? I'm sorry, do I buy it back at 50 or 60%? Or do I just wait on it? What do you think? I know if it goes down, I want to wheel it into, put it in the wheel. And I just want to know, what do I do with that? It's kind of a tricky thing for me and I'm not sure. So if you could answer that, that would be awesome. Thanks.
So Charles, we kind of just answered that, right? We answered why I close. So the percentage though is completely up to you. That's completely up to you. All right. If 50 or 60% is what you kind of want and you're happy with that, think about this to yourself. If you'll regret not taking the 50, then 50 is your number. If something goes bad and you say to yourself, shit, I could have taken 50. There was a day where I had my finger on the mouse, I could have taken 50. Then that's your number. If you're like, oh, I lost 50% of it, not a big deal, then maybe you want to go up. But for me, I just got into the 70% because 75% is a really easy number for me to do math in my head on. I can take the value of an option, divide it in two and add 25% back. Like that just number is very, very easy. That's where I got to 70% as opposed to 60. If I did 60%, I'd have to be like, all right, 50 is it divided by two. And then I have to take another fifth of that. I really just chose 70%, 75% because it's easy math for me to calculate in my head. But once again, I'll reiterate what I just mentioned. Close it out. If you have a cash secure put and right, we know and the share price is climbing, we're getting close to expiration. Unless like this thing is shooting up so fast and like you picked a strike because that's what you found the value of the thing to be. Like say for example, you did your analysis and you're like, this is why we sell cash secure puts, right? When we would want to buy 100 shares at a particular price. So maybe you got a price in your mind, it's $50. And $50 is your hard stop. That's pretty much the highest price that you'd buy 100 shares for. Well, now it's climbing 57, 58, and the value of that option, you're going to get 50% back. Well, to roll and get any sort of premium and keep profiting, you're going to have to move your strike up. But maybe you're like, shit, I'm not paying 55. I don't want that strike. That might be an instance where you have that put and you ride it out a little bit longer to expiration. And that's something we really didn't even mention in that previous video. On the put side, you have to think about that strike price because that will be the price that you have to buy shares. Now, if you would like to buy the stock at 58, you have no problem at 58, but you wrote 50, you're like, well, now you have $8 of strike leeway. Take the 50%, buy to close that option and move your strike up to 55. You're probably going to do better. That's rolling up and out. You're probably going to profit even more for the reasons that we've discussed previously. But if it's at 58 and you're like, no, I don't want to buy 100 shares, or I don't have the collateral, the cash. I only get $5,000. I can't write a 58 strike. That might be a reason why that you might want to hold it. But I'm a firm believer. 50 is a little low. 50 is a little low if I'm wheeling, right? I'll probably stick around, hang out for 50 because 50% more is a lot. But for me, 25% isn't generally worth it. And also 25% seems to be a really good number that I can make up rolling out into a future expiration. It might be hard to make up 50% rolling that out to a future expiration. You dig? Cheers.